Hold on, let it start.
I cannot see
Okay.
it.
Yeah, today we are doing chapter 8, which is revenue from contracts with customers. Revenue from contracts with customers. Now, what is revenue? Yes, anybody, normal definition. What is revenue?
Sales.
Okay. What do you understand by sales? Yes, what is that sales?
It's the price plus the profit margin.
What price?
Price from the transfer of maybe goods and services. Mm.
Price or transfer
We
of
can
goods?
say
Yeah, go ahead.
it's the economic benefit we get from exchange of goods and services or from the transfer of goods and services. That's revenue.
Okay.
It's the economic benefits we derive from sales of goods or services.
Okay. So revenue, earnings, right? Sales can also be a proceed, right?
Yes.
Right? It can be a consideration, right? That
Of
you
course.
get from a contract. In contract, we call it consideration,
Yes.
right? In disposal, we call it proceeds,
That's it.
right? Now, revenue is what you get, the value you exchange for goods, all right? Now, Ifrs still talks about revenue from contracts with customers. Contracts, revenue from contracts. Now, IFRS 15 is issued in May 2014 as part of our IASB and FASB, all those ones. And IFRS 15 replaces IS 18 on revenue and IS 11 on construction contract. So the two contracts have been replaced. I mean, the two standards have been replaced with IFRS 15 and then consolidated together. Okay. Now, the essence of this IFRS 15, the objective is to report useful information about the nature, the amount, timing, and uncertainty of revenue. Right? So we need to understand the nature of revenue, the amount to be recognized as revenue, right? The time at which we recognize the revenue, and of course, the uncertainty of any revenue and its related cash flow. Now, something happened sometimes back. There was a discussion in my alma mater, IIT alma mater. Then we had a discussion on, no, someone posted it on the group and said that someone has shares in one company, like a parent company. Yeah, someone is a parent. And then there was a share of revenue from the subsidiary. Subsidiary made profit. And then there was a share of profit, not revenue, sorry. There was a share of profit from the subsidiary. And the share of profit, they've not shared that profit. Well, there was no share of profit, but there was dividend shared. Now, the person was looking at the difference between the two. And then we made it known that there's a difference between share of profit and cash given to you. Let's take, for instance, an individual who has an investment. There's a difference between revenue given to you or the dividend shared to you. Because dividend given to a shareholder is his own share of the profit, right? His share of the distributable profit. Am I right?
Yes, sir.
Yes, sir.
Now, this person was confused on how much to record. Dividend given to them or money given to them like dividend. Yeah, dividend given to that person was, let's take for instance, 5 million naira. And the share of profits, according to the percentage of shares he has in the business, the share of profit is around 20 million naira if they share the profits. Now we need to understand that one of them is a cash flow. Dividend given to you is a cash flow. It will affect your bank account. But profit of the business is not a cash flow. Revenue is not a cash flow. Profit is not a cash flow. I don't know if I'm making any sense. Am I? Is anyone there?
Yes, sir.
Yes,
But
sir.
please just
Yeah.
explain.
Now, here we have to look at when do we recognize revenue and what is the related cash flow to revenue. Now, revenue is recognized to show the transfer of promised goods to customers, right? To depict the transfer of goods that have been promised to a customer in exchange for consideration that the entity expects to be entitled to. So revenue is a consideration. Revenue is not profit. Revenue is not cash flow. It is not, sales is not cash flow. We can have cash sales, which automatically is also your cash flow. But of course, we can have a credit sale as well, which we have a different timing. I hope I'm making a sense here.
Yes, sir.
Please, I need 1 second, please. 1 second. Now, as I was saying, sorry about that, please, I'm back. Now, as I was saying, revenue is definitely different from cash flow. Now, customers are parties that have contracts to receive goods and services, right? Customers come to your shop to receive goods and services. These goods and services are products from a company, from an entity, from economic activity. Customers are those ones expecting goods and services, right? Now, these customers are expecting it from the business, and the business is expecting revenue as a consideration for the goods and services sold or rendered. So the principle is operationalized through a 5-step model. Principle of revenue, how to recognize revenue. We have 5 steps to recognize revenue. The first thing is for you to recognize a contract with a customer, right? So you need to recognize your contract with a customer. Now, before a contract can come up, usually a contract is negotiated, right? There is an offer there is acceptance. Now, in between offer and acceptance, there is, what do we call it? There is a negotiation going on, right? So, and that's why you can have offer and you can also have a counter offer. Am I right? Whereby the customer will say, no, I don't want this. How about you give me this? And of course, it is not only a supplier or a business who proposes a contract. Customers also take a business to the business, right? Customers also take contracts to the business. Customers initiate. Now, after you negotiate this contract into a single commercial package, right? Now you look at the consideration involved. Don't forget, it's a contract, which means when there is offer and acceptance, there must be a consideration. You look at the consideration involved as well. Look at the goods and services across the contract. If it is worth the consideration, that's fine. Then also ensure that your contract is approved by all the parties. That is, both the supplier and the customer must approve the contract, right? Now, the rights and payment terms are identified. All right. Now, payment terms has to do with when do you pay, how much do you pay, what's the mode of payment, right? Then also, the contracts must have a commercial substance. Yeah, it must have a commercial substance. That is, these are the goods and services, and this is the consideration. So it must have a commercial substance, and there must be probability that the entity will collect consideration, that the company will earn a revenue from that contract. So that is a contract of sale. That is a revenue. That is revenue from contract. So there must be probability that the entity, the company, the reporting entity will earn a revenue or will collect a consideration from that contract. Now, if there is no consideration, or if all of this discussed, if all of these items are not met, that is negotiation, goods and services, consideration, rights and payment, if all of these are not there and revenue comes first. Now, when revenue comes first, you will not refer to it as a revenue. It is a liability. Am I right? Advance income received in advance is a liability. Please, am I right?
Yes, sir.
Yes, sir.
So it's a liability when you receive money before you deliver items. It is a liability, not a revenue. Now, after you identify the contract, you also need to identify the obligation, performance obligation. What is required for you as the business? Number one, you are expected to produce goods or provide services. Number two, or you are expected to deliver a series of distinct goods and services with similar transfer pattern. Right? Now, it could be a goods and it could be series of goods. It could be a turnkey project, a one-off project, and it could be something that will continue for a particular period of time. Does that make any sense, please?
Yes, sir.
Yes,
Yeah,
sir.
that's it. Now, these items we are talking about, these goods and services we are talking about, is distinct if the customers can benefit independently from those items. Right? And also, if it is separately identifiable within the contract. If the goods is identified, if the customer can benefit independently, then that's a distinct goods or services. Now, if it is not distinct, that means combined with other goods and services. If it is not distinct, it is combined with other goods and services, right? Now, until a distinct bundle is formed. For instance, I go into a market. We call this an unidentifiable product. I go to a market and I told the seller that I want to buy rice. I want to buy 5 Congo of rice. Or I want to buy 25 kg of rice. If I want to buy 25 kg, the rice seller has different products, right? We have Royal, we have every rice we have. Now, on this rice, I just told him that I want 25 kg of rice, and he opened the store and sold one to me. Until it is distinct, until it is identified, then it is not yet a contract. So usually when you are forming a contract, you should know what you are transferring. What am I expected to do? It is the contract that will say that I want this particular name of rice. So that means it has to be distinct. And if I come to your store and I say that I want this rice with no particular one, then until you tell me that, okay, this is the one I'm selling, before the contract holds. Of course, there can be a contract even when the product is not identified. And that's it. Now, after you know your duty, your performance obligation in the contract, the next thing is to determine the contract price. And that's why you should know the products. You should know the product. Suppliers will tell you that I am money go talk, right? Soup way sweet, na money killer. Better soup, na money killer. Do you understand? Now, when you identify the product, that is when you can give us your selling price. All right. Now, what is the amount you are expecting from that product? Now, this amount, if it is a contract of sale, is different from any tax. You have to exclude the tax value. And don't forget, we have 2 types of tax on a sale. Am I right? On an invoice, there are 2 types of tax that are usually involved. Can someone tell us the 2 taxes?
VAT and consumption.
Value added tax.
And what?
Consumption tax.
What is consumption tax? What is VAT?
Oh,
Is there any difference between consumption tax and VAT?
It's withholding tax.
Yeah, it's withholding tax. I'm just asking, is there any difference between consumption tax and VAT?
No,
It's the same thing.
they're the same thing.
VAT is consumption tax. VAT can also be sales tax. And that's it. Even though there are some states that are charging a different consumption tax apart from sales tax. They are charging consumption tax on some products. And
yeah,
Lagos,
that's why I mentioned it. Lagos State.
yeah, Lagos is charging consumption tax. And not charging consumption tax on every product. Only specific industry or sector is charging consumption tax. They are charging it on events, hospitality, and I think restaurants, yes. hotels, restaurants, and event centers are the ones charging consumption tax. Okay, that's by the way. Now, the two taxes that we are talking about here is value-added tax and withholding tax. Yes, go ahead, sir. I think someone is raising his hands. Go ahead, please. I thought someone was raising his hand. Okay. Now, these two taxes, there are some of the taxes that are to be excluded. There is one that you will not exclude. Sales tax is to be excluded because it is called, what do we call that tax? Refundable tax. Right? We have refundable tax and we have non-refundable tax. Refundable in the sense that the two of them are refundable. And don't say they said one of the taxes is irrefundable. Yes, two of them are refundable. And I'm saying it. Value-added tax and withholding tax are refundable taxes. But there is a way we call it, we call one of them to be refundable and another one to be not refundable. Refundable is that you will get it back in the same month immediately. Once you are selling that product, you are getting it, you are getting the tax you paid on the purchase, which is the input VAT. You are getting back the input VAT immediately from the output. So you have to deduct your input VAT from your output VAT. That is on VAT. And withholding tax is that it will wait for you as a tax credit till the end of the year. So that's why we call withholding tax and non-refundable tax. But that doesn't mean it doesn't wait for you. It's still your money. You meet it at the end of the year as a tax credit. But it's a credit. Just like VAT, well, VAT is not a credit, sharp. It's just net amount that is payable, net VAT payable. Now, if there's any tax in your transaction price, you deduct it. And this tax we are talking about is your sales tax, which is your VAT. Right? Deduct VAT because that VAT does not belong to you. Even the element of that VAT that belongs to you will not go for the invoice, will not go for the amount on the invoice, your sales price. Now, what you need to consider is your variable consideration on the transaction price, right? What's your variable price? What's your variable cost on that item? For instance, discounts, rebates, bonuses. You have to consider those items. Then also you look at the time value of money. If payment is deferred, if it's a deferred payment and will be paid in the future. This is SBI, so I don't need to be explaining some things. I want to believe as I'm saying it that deferred, you know what a deferred payment is automatically. And I will expect that if you don't know anything, or one particular thing I'm saying, you can always call me back. I might not explain everything. And that's it. Then also, you look at customer's credit risk. What is the credit risk? What is customer's credit risk?
The risk that they will not pay on time.
Thank you. They will not pay their debt when it is due. All right. So that's it. Then transaction price must reflect the customary practices and probable consideration. All right. That's it. Now, after you've determined your transfer price or transaction actually, this is not internal. Then also, you shall locate the transaction price based on standalone selling price. All right. Allocate your transaction price on the item or on the performance obligation based on a standalone price, that is selling price per unit. Then discount allocation is permitted to specific obligation. Don't forget, this is SBR. not SFM or PM or cost accounting. All right. So look at the discount. Discount allocation is permitted, and it is permitted when goods and services are sold separately, and when bundles are routinely sold at discounts. Right. And also when the discount matches observed discounts for those bundles. Right. Okay, so that's it. Now, once you are done allocating the transaction price, then you recognize your revenue when performance obligations are satisfied. When you've done your own part, you've delivered. When you've delivered the product or you've provided the service, right? And also, a performance obligation is satisfied when control of the asset has been transferred to the customer. That's when you deliver a product, though. When control is transferred to the customer. Now, what time do you recognize revenue? You recognize revenue over time if customer simultaneously receives and consumes the benefit. That is, you send it to the customer and customer receives it immediately and consumes the product immediately. You have earned that revenue. Secondly, when performance creates or enhances an asset controlled by the customer. When what I've done has increased the value of the asset I gave to the customer. And also when there is no alternative use to the entity and there is an enforceable right to payment for work completed, I am done with your product. I am done with your design. You are now asking me, you are now saying that you don't want again. What will I do with the product? Now, when there is no alternative use for the product, automatically it's been sold out. You don't have a choice. You don't buy market. Right? So that's it. Or when the seller, when the business has an enforceable right to payment. So the business has not breached any of its obligations in the contract. All right, and that's it. Now, I hope we can proceed, everyone. Shall we proceed, please?
Yes, continue, sir.
Okay. Now, we have at a point in time. The first one is over a period of time. Second is at a point in time. Now, where none of the above criteria are met, revenue is recognized at the point when the customer obtains control. Immediately the customer obtains control, you recognize revenue. Are we together?
Yes.
Yes, sir.
So you recognize your revenue immediately. Now, how do we measure the progress towards satisfaction? We have the output method. Now, output method is based on value to customer. If you want to measure your satisfaction, your customer satisfaction, it is based on the value you have created to your customer. right? If it is a contract of construction contract, we have the milestone reached, right? Also, we have units delivered, right? We also have time lapse. All those things are values that can be created to a customer. Are we together, please? There are values that can be created to a customer. And this may not always be observable or cost effective. Yeah, it may not. Now, another thing we have is for inputs. The first one is output method, which is the value you have created. The input method is on the effort you have inserted. Effort you have inserted in production, right? And also, this must be faithfully representative of the performance progress. Your efforts must be documented and it must represent your performance. Now, you need to understand that revenue is not invoicing. You issued an invoice, that's not a revenue. I don't know if I told you about one of my clients who wants to claim the rent relief allowance. And I asked him to make his receipt. And the person was grumbling. And I was like, what is my own? They gave you an invoice. They didn't give you a receipt, evidence of payment. Revenue is not invoice until it is paid. Now, IFRS 15 provides specific guidance for complex contract food deliverables. And we have emphasis on transparency, consistency, representation of contractual performance in anything you want to do in revenue. So you have to be transparent enough, you have to be consistent. Then also we have input method under IFRS 15. Now, for the input method, you have a criteria that must be met. And the criteria is that customer must receive and consume the benefits. Once the customer receives and consumes a benefit, you can't recognize it. Then also, revenue should be recognized over time using a time-based input method. Yeah, time-based input method is time you spent on the production. So yes, revenue should be recognized. Are we together, please?
Yes.
Yes.
So that's what we have there. Now, the best measure of progress, just like we said, you can use a time-based measure. Okay, you can use a time-based measure, and you can also use appropriately where services are provided evenly over the contract period. When services are provided evenly over the contract period, you can consider that. Now, the input method is recognized on these efforts, right? And this input method just can be labor hours or labor cost. labor hours or labor cost. Now, important notes on the input method. The input method can be a straight line method. Are we there?
Yes.
Now, the input method uses a straight line method. And this straight line method is where inputs are uniform throughout. When input is the same thing in terms of cost, in terms of hours. Now, for your input method, we said it earlier that you need to exclude inputs that do not control, that do not transfer control of goods and services. All right. Now, those items, those inputs that do not transfer control, get them to waste material, wasted material. Right? So a wasted material is uh, where there is misappropriation, like fraud, right? And it could be by mistake, it could be incompetence. All right, so that's what we have there. Now, it could also be inefficiencies, wastages, pilferages. You know what wastage and pilferage is, right? Yes, I'll take it as yes. Now, there are some adjustments, however, required, which is that when costs are inefficient or costs don't compress, then you don't apply it as part of the input method for revenue, right? Then, of course, clear costs are not proportional to performance, that is indirect costs. Indirect costs, they are also there. Now, we have cumulative cost recognition as well. Revenue is measured cumulatively. All right. And you recognize revenue, you recognize only the incremental revenue for the current period. If some has already been recognized earlier period. Are we together, please? So it can be a cumulative recognition where you recognize.
Your voice is breaking. I can't hear
Sorry,
you.
Olariwaju, please can you mute your mic?
Sir, your voice is breaking.
can someone else confirm that my voice is breaking?
Sir, please mute everybody. Mute everybody. Some people mics are unmuted and it's causing echo.
Okay, sorry. So let's mute everybody now. All right, Raju, what did you do? Like, okay, it's muted. In natural sense, I don't like to mute everybody. Okay, I hope you can hear me now. Shall we
Yes, we
proceed?
can hear you, sir.
I can't see anyone to mute here. Okay. Now, as I was saying, revenue is measured cumulatively when and you recognize only the incremental revenue for the current period. If some had already been paid in the earlier periods, right? So customers have paid. Only the incremental period is what you record. Then also, we have cumulative recognition. We have factors affecting the transaction price. For factors affecting transaction price, before you can tell us this is the price of your product, right? We have to look at the variable consideration, right? The variable consideration is important. And what is your variable consideration? All your variable costs, I mean. Am I right, please?
Yes, sir.
So you look at your variable costs, including discounts, concessions, price concession, penalties and returns, contingent outcomes, and the rest of them. You consider that in your variable cost. Then also, you look at the sources of your variability. Sources of variability. What causes that variable cost? All right. Now, to look for the causes, the sources, you need to be explicit in contract what the sources of the variability will be. When we say explicit, it means it must be boldly stated in the contract outrightly. And it implies the customary practice and the published policies of the financial statement, as well as the intention to offer price concession. Intention to offer price concession. So all these are what we have. Now, you use your estimate or you estimate your variable consideration using either most likely or expected value, either the most likely amount or the expected value. Now, for expected value, we have it to be weighted estimate, right? That is the revenue multiplied by the probability. Are we there? Are we there, please?
Yes, sir.
Okay, so that's for your expected value. And we use expected value for large volume contracts. You also have the most likely amount, which is the highest probability of outcome. For high probability of outcome, yes, the most likely amount, the amount with the most with the highest probability of occurrence, and that's it. Now, consistency is required throughout a contract. Now we have constraints on recognition. The constraint on recognition include only if it is highly probable that a significant reversal of cumulative revenue will not occur when uncertainty is resolved. Right? So that's one of the problems of recognition. So constraints on recognition would include only if it is highly probable that a significant reversal of cumulative revenue will not drop any. It will not drop or that this significant reversal will not occur when uncertainty is resolved. Now, of course, when there is probability, there is uncertainty, right? The probability that a significant reversal will not occur, yes, that's the constraint on recognition. So you need to recognize that constraint. Then also, when you have a refund liability, You have to recognize the refund liability when the customer is expected to return part or all of the goods. So you have to recognize that there will be a refund and it's a liability. Now, also, we are to measure this refund liability at the amount not expected to be retained. Right? So if someone else comes to buy this thing, at what amount am I not expecting to retain the figure? At what amount do I intend to sell? And that's it. Then also, I am to regulate, or you have to update regularly your changes in the refund liability, if there is any. Changes in refund liability. So that's it. Now, allocation of variable consideration. You can allocate variable amount entirely to a performance obligation. Okay? And the variable payment is specifically related to the obligations, and the allocation aligns with Ifrs 15 that we are working on. Do you have any question from anyone, please? Shall we proceed?
Yes, sir.
Okay. Now, we have sales-based and user-based royalties. We have sales-based and user-based royalty. Shall we proceed, please?
Yes, sir.
Okay. Now, for the sales-based and the user-based, usage-based, revenue is recognized only when both sale and usage occurs. Are we there? Now, when the two of them, both sales and usage-based royalties, when they occur, that's when you recognize your revenue. And also when the related performance obligation has been satisfied. Do you understand now? So that's it. Now, the significant financing component we have. Significant financing component occurs when time of payment creates a financial effect. Right? When the time of payment creates a financial effect. And how does it create a financial effect? For instance, when you are paying in installments or you have deferred the payment. All right. Yeah, it will have a significant effect on the account. Then also, entity must adjust the transaction price to reflect the time value of money. So money you are receiving in 2 years' time, what's the value now? Right? So that's it. Now, no adjustment is needed for your financing component. All right? Where it has where it has a financial effect, you don't need to do any adjustment when the time gap is less than a year. If everything is within the same accounting period, then you don't have any issue. Now, for discount rates, it has to reflect the market interest rate, right? So whatever discount you are giving out must reflect the market interest rate for similar financing transactions, and it must reflect credit risk. All right? It must influence or reflect credit risk, collateral, and timing of the cash flow. So that's it. Now, how do we present revenue in our financial statement? First off, revenue is usually the first thing we record in an income statement. Hello, everyone.
Hi, sir.
Hi, this class is very dull today. And that's because I'm the only one talking. Please, I need you guys to say something too. I'm sure you've heard of revenue before. This is a professional class.
We are with you, sir.
So I'm sure you've heard of revenue before. You're
Yes,
acting like you've not heard most of these things before. And that's why you're not contributing. All of you are too silent. I need you to say something. Now, in your financial statement, we have interest income and we have interest expense, right? And that's where the financing component of your revenue is, right? If you're getting an interest income or interest expense, so that one must be separately presented from revenue, right? Yeah, it must be separately presented from revenue. That's it. Now, we have principal and agent consideration, right? Who is a principal and who is an agent? A principal and agent. Yes.
I think a principal is the owner of a goods or owner of a property.
A principal is the owner of a business, and an agent is the one that acts on behalf of the principal.
Yeah, exactly. The agent acts on behalf of the principal. And that's it. Now, an entity is a principal if it controls a promised goods or services before transferring it to the customer. Right? So if I have control over my asset, definitely I am the principal. Now, me, the principal, I'm responsible for fulfilling the performance obligation that are on that contract. Right? Either directly or indirectly. So that's it. Now, then also the principal is to recognize the gross revenue. That is the full amount. So that's it. Now, merely obtaining a legal title before transferring a product to the customer does not make you a principal, right? The fact that you have the legal title before you transfer it does not make you the owner. Don't forget, under lease, the owner of the leased item has the legal title, right?
Yes, sir.
While the tenant has the possession. So if it is what we have two lease, operating and finance lease. If it is a finance lease, the fact that it's in your name, you have the legal duty. I mean, you are the legal owner. Does not mean it's your own. No. I hope you understand that.
Yes, sir.
Aha.
Sir, please can you repeat that? Sorry.
Sorry.
What you just said now about not being the legal owner, can you just
Mm.
repeat, phrase that statement, please?
So a legal owner is the person that is recognized by law as the owner of an item, right? But in accounts, yes, that legal ownership does not, we don't have any business with it though. That's why we have substance over form. All right. And substance over form says that we don't care about your legal identity, your legal title. Instead, we look at the substance of the item itself. So that's it. Now, an agent is an entity when its performance obligation is to arrange for goods provided by another party. That is, goods that have been provided by the principal, right? Goods provided by the principal that has been, you, the agent, are to arrange it. So that means you are an agent. That makes you an agent. Then also, you have to recognize revenue only for the commission or fee you have received. Agent fee, agent commission, right? We don't mind, even if it is self credit commission. We don't mind. And that's it. Now, also, what makes you an agent is that another party is responsible for fulfilling the contract. You are not the party responsible to fulfill the contract. Another party is responsible. Then also, there is no inventory risk borne by you or your company, right? So if there is no inventory risk, what is an inventory risk, please?
Is it that
What's
you
that
not make
inventory risk,
sales?
anyone?
A risk of not making enough sales? I don't know.
Risk of what?
Eh,
Loss making. Yeah, I cannot understand that one. Yes,
Is it
anybody?
the risk of maybe the product being
Uh-huh.
destroyed by maybe fire or something, or accident? Risk of not fulfilling that obligation,
Risk of what?
not maybe due to the not fulfilling the obligation of um, the customer getting that product due to maybe hazards or something.
I won't take it away.
The
Okay.
risk of not
Maybe
making
it's the risk
enough
of
sales.
the stuff being tied down, not
Sorry?
making sales, being tied down.
I didn't get that.
So the risk of not making sales, the product being in inventory for a long time, not being sold.
No, I wouldn't call it that. I'll call it the risk that the product will go bad. Probably the product will expire or will be destroyed by fire or will be stolen. That inventory risk is not borne by the agent. That is, if the risk occurs and the business and the products gets destroyed, agents will not bear the burden. Agents will not bear that risk because it's not the owner of the goods. His own is that, okay, the seller has arranged it. You just arrange it. I mean, the seller has produced it. Your own is to arrange it and then sell it out. So you know, concern am. So that's it. Now, also, when you don't have control over pricing, you are an agent, right? When consideration is in the form of commission, you're also an agent. Just think of your house agent, apartment agent. Then also, when there is no exposure to credit risk from customers, no exposure to credit risk. If customers like, they should pay. They like, they should not pay. Then, if that is your attitude, then of course you are an agent. Because whether customers pay or not, whether there is sales or not, agent fee must be completed. And that's why you will say that whether there is sales or not, the carrier's money must be completed. And that's it. Now, sales with a right of return. When you sell with the right that sales can be returned, right? And it is when a customer purchases goods and also has a right to return the goods, right? In a situation like that, you only recognize the revenue for the portion that is not returned, or the portion you are not expected to be returned. Then also, for your refund liability, you have to record your refund liability for the expected returns. That is the money you refund the customer when they return the goods. That sales returns in what, Abby? Then
Yes,
also the return asset, an asset for the right to recover the goods from the customer with a corresponding reduction in cost of sales. So that return item will affect your cost of sales. And that's it. Now, we have repurchase agreement. Where there is an agreement that a product that is being sold can be repurchased by the seller. It is a repurchase agreement when there is a contract under which an entity sells an item, but also has an obligation or an option to repurchase the item. It's just like sales and return, right? Sales and return, or where you have what do we call this lease?
Sale and lease back.
Sale and lease back. Thank you. So that's it. Now, if repurchase occurs, that means no control is transferred to the customer in the first place. Right? So there's no transfer to the customer. No control is transferred. And it is treated as a financing arrangement, not a sale, just like sale or leaseback. It's a financing arrangement. Then also, account treatment. All right. Now, your your repurchase agreement, it also occurs when it is treated as financing arrangement, right, and not a sales. For the accounting treatment of this repurchase agreement, you have to recognize the financial liability, not a revenue. A financial liability is to pay back later. And that's it. Now, example, of course, then also you continue to recognize the asset, and the difference between the sale and the purchase price is treated as interest expense. Okay. Now, we also have due and hold sales. Let me see where we can stop in this. material. Please, can we complete this topic? I'll just take few more time. Now we have bill and hold sales. And this is an arrangement that occurs when goods are billed to a customer but are held by the supplier at the customer's request. So I've given you, in fact, you are paid, but you're telling me to still hold on to it. You are coming to pick it next week, and you have paid. All right, so that's it. Now, in this case, revenue can be recognized before delivery if the following conditions are met. Don't forget, there's actually a sale, right? There is a sale. But the issue with the sales is that you are still holding it. You sold it. The customer has agreed that you sold it, but he's saying that no, you should still keep the item. So you can recognize your revenue when the reason for the arrangement is substantive. When the reason for the arrangement is substantive, right? Aha. So probably the customer has no storage space. And also when the product is separately identified as belonging to the customer, the fact that it's in your care does not mean it belongs to the customer. I mean, it does not mean it belongs to you. It actually means it belongs to the customer, even though you are in possession of it. Then also, when product is ready for delivery, yes. And the last is that seller cannot use or redirect the product. So let's say I came to buy a car from you, and that car, I told you to hold on to it, that I'm coming to pick it up when I return to Abuja next week. You cannot use my car to do anything, no. When I've paid, you can't use my car. And that's it. Then also, you have the examples, right? So the examples, you can look at the examples. Now you also have the consignment sale. Consignment sales involve sending goods to another party. Sending a consignment to a dealer to sell to the customers. Right? So in this case, you are sending the goods to someone in Lagos to sell for you. Now, revenue is not recognized until the control passes, until that goods is sold. The fact that I sent the goods to you does not mean it's your product, though. Does not mean you have control over, does not mean I have sold it. Until I pass the control to the customer. That's it. Now, the indicators of a consignment arrangement is that seller retains the control of the product until a specified event, probably the final sale. Another thing is that seller can require return of the product. Right? Then also, dealer does not have an unconditional obligation to pay for the product. No. I don't have a condition that I must pay for the product. There is no law that says that I must pay for the product. My own is to collect it for you and sell on your behalf. And that's what I am doing. Okay? So that's it. Do we have any question, please? Any question from anyone? Now, this is where we end our class tonight. In our next class, we'll go into PPE. In our next class, we go into PPE. All right? Yeah, we'll go into PPE in our next class. Do we have any question before we end the class?
Sir, please, the second indicator of a consignment arrangement, I didn't get to that part.
Consignment arrangement. Second what?
The
Indicator
second indicator, yes.
that seller can require return of the product.
Okay. Thank you, sir.
All right. In the absence of question, I guess we'll meet again next week in our next class.
Thank you, sir.
Good night, everyone.